But it's a very different experience when you're buying real estate, and especially in an environment of easy money and lax underwriting standards. In which case, you're no longer putting down 20%, you're not even putting down 10. In many cases, a lot of these homes were financed with no money down, very little documentation as to your creditworthiness, whether you had a job or not even didn't seem to matter. This was a very toxic combination, but it was especially toxic for this reason. When you and I lose money in the stock market, we're worth less, but it's our problem. When you lose money in real estate and a bubble of this magnitude bursts, it's our problem, but it's also the banking system's problem. Those ultimate investors who purchase these bonds made up of all these different mortgages, now all of a sudden that's clogging up the banking system, and it began to seize up. They stopped making loans because their ability to do so was impaired. Their creditworthiness had been shattered. Their capital ratios had fallen. And this is true not only in the US, but because in our largesse, we sold these bonds to a lot of companies in Europe, the European banking system began to seize up as well. So it's not simply a matter like it was in 2000 that, well, we'll get on with things. You know, eventually the economy will recover and people's portfolios will once again resume their ascent. Very different experience when now all of a sudden the banking system is involved. Because if the banking system isn't working properly, the economy is being starved of its lifeblood, which is credit. Most of the things we do require credit, by and large, and it just simply wasn't happening. So it forced the public sector to get involved and, in essence, help the banking system get on its feet. And so when you say to yourself, gee, we've been expanding now for almost 2 full years. The recession ended at the end of the second quarter, 2009, so we're coming up on the second anniversary of it. We're growing at roughly about a 3% annualized rate right now. And you say to yourself, well, gee, what happened? You know, has it all gone away? Is everything just fine now? Well, the answer is no. It's not all fine, and it hasn't gone away. Because that bubble that appeared in technology stocks migrated to real estate, migrated to the banking system, and now it resides on the books of the federal government. If you look at the explosion of debt that's been created in an effort to bail out the private sector, mostly the banks, but also to stimulate the economy because the private sector wasn't pulling its weight, now all of a sudden we have outstanding debt that is roughly about 70% of our annual gross domestic product. When this recession began, that ratio was under 40%. And it's rising. The deficit this year will be $1.5 trillion, according to the Congressional Budget Office. So we are adding to this outstanding pile of debt every day that goes by. Now, does that mean that necessarily we're doomed to some other shoe dropping down the road and this still somewhat fragile economy and expansion reverting back into recession? The answer to that, in my opinion, is no, we are not doomed to that outcome. But I think we will arrive there unless we do something about this budget deficit. Now, there is the political will among the electorate that this should happen. And all you have to do is look at the results of the midterm elections to reach that conclusion. But the broader question, more serious one, is there political will in Washington to do this? Now, we don't need to address these deficits in 1 year or 2 years. In fact, that would be counterproductive. If we were to extract from this economy enough spending to get our deficit under control, we would slide back into recession. So we need to do this over a period of years, 5 years, maybe 7 years. In fact, let me put some numbers on this. You can only sustain a budget deficit that is equal to the pace at which your economy is growing. So in our case, that's 3%. And yet this year's budget deficit equates to 10% of annual GDP. So we need to shrink it by 7% of GDP. If we did 1% a year for 7 years, that would be something that I think we could handle relatively comfortably. It would send a message to our creditors around the world that we're serious about paying off our debts to them. It would have the impact of strengthening the US dollar, in my opinion, and it would get us back to a more sustainable and profitable and prosperous future. So this is going to be a very interesting budgetary cycle that we're about to embark on in Washington coming up in just the next few weeks. The more vocal deficit hawks have said the line in the sand for us is going to be the debt ceiling expiration, which occurs at the end of March. This is the line in the sand that they've drawn, and they've said, if we don't see some meaningful progress in putting a program together that is credible and sustainable, then we're going to have to take more drastic action. So we're going to have to wait and see. But we have an opportunity to do this. If you think about sort of just basic economics, and think about running your own businesses or even your own personal finances, when times are good, it's the time, you know, to get things in order, to repair your balance sheet, pay down some debt. We've got that opportunity now as a nation, and so it remains to be seen whether or not we seize it. One final point about this, and then I just want to spend a few moments on sort of where we think we go from here. But this particular recession, because it was accompanied by a financial crisis, makes it somewhat unusual. Most recessions simply come about as a result of the normal business cycle, whereby you have a nice expansion that lasts, let's say, 3 or 4 years. You start to get some inflationary pressure. The Fed raises rates to slow it down, and then we have a recession. Fed lowers rates and gets us moving again. This time around, it was accompanied by a banking crisis, a financial crisis. And the history of Western economies, going back over 500 years, repeatedly shows that when you have a recession that is also accompanied by a banking crisis, that the ensuing recovery is subdued by historical standards, and the pace of that recovery and the road to higher ground takes much longer than the recovery from just a normal run-of-the-mill recession. This one is unfolding exactly according to that historical outline. We think we're going to see the economy expand this year at roughly about a 3% rate. There are some who think it could be as much as 4. Well, let's split the difference and say 3.5. Coming out of a recession as severe as the one we had, you would hope and expect to see, under normal circumstances, growth rates up around 5%, 6%. It should be roughly a mirror image of the depth of the prior recession. But when you have a financial crisis, it takes the banks longer to get to a position of health. It takes them longer to the point where they're comfortable making new loans. And we have this overhang of debt that needs to be serviced. So this one is unfolding according to that plan. And as a result, unemployment's going to remain high, higher for longer than we're comfortable with. Right now it's running at 9%. We don't think it's going to be very much lower than that by the end of the year. If we get lucky again and we grow it around a 4% rate, we'll probably put a little bit of a dent in that, maybe get it down to 8.5. By the end of 2012, I think you should prepare for unemployment that's running at around 8%. So this is going to be a little bit of a different recovery. That doesn't mean there aren't opportunities out there. We think there are. And in fact, from an investment perspective, we think the stock market's probably going to do okay this year. But the returns are going to look more like their historical averages. So roughly 8 to 10% returns is maybe sort of a benchmark that you might think of. Now, what markets do we like? Well, in the industrialized economies of the world, we think the US is the best positioned. Now, it's an interesting statement to make because, as I just said, we're only going to be growing at around a 3.5% rate. But that's a heck of a lot better than what we expect to see out of Europe or Japan, where you're going to see maybe about 1.5. And one of the reasons for this disparity is that the philosophical policy response to the downturn that we've taken in the United States is very, very different from that that's been pursued in Europe. And I think it's a result of our separate collective historical experiences. In the United States, the Great Depression continues to cast a psychological cloud over our economic thinking. And especially, I think this is true because of the fact that the central bank's chairman Bernanke, is a scholar of the Great Depression. And it is his conclusion that the Federal Reserve made the Great Depression worse, and in fact turned it into a depression, by not responding quickly enough to a collapse in the money supply, nor did it get in front of the need to stimulate the economy once it became apparent that it was starting to spiral downward. And that's why he is embarking, now in the middle stages of a second round of quantitative easing. Basically simply printing money out of thin air and creating aggregate demand by spending, in essence. Buying bonds, take a bond out of your pocket, replace it with cash so you'll go buy something. In essence, that's what he's doing. Now, it's not a free lunch because every time you print $1, it makes the one in your wallet worth a little bit less. But you don't notice it because it happens sort of gradually. But that's why he's embarking on quantitative easing. And that's why we passed an economic stimulus package as sizable as it was, where in contrast, Europe is doing the opposite. Europe has said our response is to get our fiscal house in order. We're going to impose austerity. We're going to extract demand from the economy because it's going to make us creditworthy. It's going to support our currency, keep inflation low, and allow us to borrow at low rates. Very, very different philosophies, and we won't know which is the correct one for some time. But I will point out that in the United Kingdom, where they have pursued this policy, their economy shrank in the fourth quarter, unexpectedly. It was just announced 2 weeks ago. So we'll see how this plays out. My money's on Bernanke, to tell you the truth. But it comes at a price. The $600 billion of money printing, in essence, is a loan that we've created for ourselves. Down the road, we have to pay that back. All of this stimulus is a loan. We have to pay it back and get our house in order. So the economy is starting to improve. The private sector is doing relatively well. Manufacturing is very robust. The consumer is coming back. And this is critically important because we are at a point where the economy is transitioning away from reliance on the public sector to greater reliance on the private. State and local governments are shrinking. They're laying people off. Federal government, hopefully, is on the verge of doing the same thing, cutting spending. So we're going to put more reliance in very short order on the private sector, and just at a time when it looks like maybe they're capable of handling it. But Europe, very, very different process. So we'll see who wins up. Our expectation is that we're going to come out of this in good shape, but it's going to take a little bit longer than maybe we thought. So a good year for stocks, not a great year. U.S. stocks look better than those in Japan and in Europe. Emerging markets, you're going to see robust growth rates, 9% in China, 7% in India, 5-6% in Brazil and in Russia. And a lot of world-class companies positioned in the United States whose businesses domestically are not all that robust, yet are doing extraordinary business in some of these locations. And that's contributing to the growth in corporate earnings that we expect to see this year. So two broad themes, by the way, and I'll make this quick. Two broad themes that we're attracted to in the domestic equity market. The first is investing precisely in those types of companies that are selling their products to the emerging markets, mostly in the industrial space, the materials space, and in the energy sector.